start early. If you're listening, start early and just get money invested. Whether it's at 10%, 5%, 15%, get your money in. Most people, though, they don't have a sense of that delayed gratification. They want everything now. They want to do the vacation now. They want to get that car now. They want to get that Starbucks freaking $7 latte with 2 pumps of pumpernickel, whatever they have in that flavoring, whatever. It's $7, $8 drink. That's costing them.
Yeah. All right, welcome to How to Invest in Commercial Real Estate.
What is up, guys?
I'm Brian, this is Joel, and for those of you who view us, you'll notice that Braden's not here today. But today we've got a great topic. Joel had a conversation with his staff about investing, and we're going to talk about that a little bit. I think people are going to be amazed with some of the numbers we come up with today.
Yeah, certain people may not have heard the statement that Warren Buffett, I think, once said is that compounding interest is the 8th wonder of the world. And I really don't believe people have a good idea of how powerful compounding interest is. So hopefully today we can kind of enlighten people, maybe open their minds to the possibility of what a good return over a long period of time can do for them.
Yeah, not just compounding, but if that rate, that average rate that you get that's compounding, the higher that is, that's really,
where the magic
really
is.
Juices the numbers.
Yeah. So what if I told you, Brian, that I could make you 40% a year? What's your first gut reaction?
I would say BS.
BS. And why is that?
Because nobody makes 40% on their money, do they? Because when I put it, when I look around, the stock market makes maybe 10%, and just savings accounts make 1%. So 40% seems unrealistic to me.
Yeah. So we've been conditioned by society to think if returns are higher than a certain level, that it must be too risky.
Really risky.
Too risky. And so let's talk a little bit, because I did have that conversation with my staff recently, and I kind of tried to pose the question, and the amounts are a little bit different, but let's say today, because our minimum is $25,000 for the investment.
Right.
For you listening, if you have $25,000 to invest, what are the options that you have? What are you thinking about doing with that money? Because everybody has different risk reward profiles. Some people want to be safe and secure. And so options for them are like savings account.
Savings account, yeah.
Well, for those listening, that earns you between 0 and 1% today.
Yeah.
It's going to go up. All right, feds are increasing the federal funds rate.
It's going to go up $250.
Yeah, I mean, it's not going to do much. Okay,
year.
And so then you could do a CD. And for those that don't know what a CD is, you just kind of guarantee the bank can hold your money for a certain period of time.
Yeah.
And for that security for the bank that they know you can't withdraw, you get a little premium.
It's a certificate of deposit.
Yes.
So maybe you get, right now, rates are going up, but maybe 3 or 4% or something.
2 or maybe
probably
3.
Not that high, yeah.
Next, I would say are like bonds, U.S. Treasury bonds, 10 years going, it's about almost 3 now.
Yeah.
Corporate bonds could do 4, 5.
Yeah. Maybe
6.
Even 6 or 7, yeah.
So then what's the next step? Most people, I would say, I'm going to throw a number, it's probably not even accurate. 80% of people just put money in the market.
Yeah.
In their 401k.
Yeah. Mutual funds,
which is a great option. And I'm not downplaying mutual funds.
Yeah.
If I was giving advice to somebody that didn't want to do real estate and they wanted to be in the market, I would say, hey, get an S&P index fund, a low fee S&P index fund, because that beats more than half, if not 2/3 of active managers.
Yeah, I agree with that for sure.
And so what can they expect when they do something like that?
Probably on average around 9% a year.
Yeah, I would say 8, 10.
Some years it's going to be higher. Obviously, some years lower. Some years it's going to lose money. And that's what makes people afraid to do some of these things, right? There's a little more volatility in stocks than there are some other things.
And so I want to talk about that. The shorter the time frame or investment window that you have, the riskier it is,
right?
To nail down that 9 or 10.
Right.
The longer you have, the less risky it is.
True.
If you told me you're going to invest for 40 years in an S&P index fund, I'd say you're good to go with 10, 12%.
Yeah.
Okay, over time. And we have a 100-year history on the stock market. That's what it does over time.
Right.
Now, that doesn't account for inflation or anything like that. That's just the bare bones of it. So we want to. Well, let me get into this. Okay, so let me try to pose some questions. I've done this before. But let's say you have $25,000. The next thing I want to go over, and I wish I had a whiteboard to show people on this YouTube podcast, but most people are listening, so they don't have that access. So let's say that you are 25 years old and you have $25,000 and you want to invest for your retirement when you're 65. Okay. And so those listening, think about $25,000 and we're going to do an exercise. So if you invest that at 10% compounding yearly.
Okay. You invest it one time,
$25,000
one time.
Literally you invest it and forget it.
Okay.
The numbers would change drastically if you contribute yearly. But let's say at 25, you flipped a house or something, you got 25 grand, you're going to invest it at 10%.
Okay.
What does that give you when you're 65?
Yeah.
And the number is, I'll make sure I get this right, $1.15 million.
Okay. Yeah.
$1,150,000.
It's good.
That's good. In 40 years, not quite enough to retire on.
Yeah, it won't be in
because
40
I
years,
think if you did an inflation calculation, that in 40 years, the 1 million is going to be worth half.
Yeah.
Okay. Maybe some people could retire on that, combine it with Social Security. Okay. What if you waited, which most people do, 15 years, and you said, hey, I'm growing a family. Yeah. I'm not making enough money. I'm saving for a house. I'm not going to start investing. I'm going to invest that same amount when I'm 40 years old. Right? Which is, I would say most people probably start getting serious about it 35, 40.
Yeah.
That drops your $1.15 million to a mere $270,000. Wow,
that's amazing.
So
you waited
just
15 years.
Yeah, just that time, you cut your investment, your total by 75% by waiting that 15 years.
Yeah.
And so that's how powerful the time horizon is. Start early. If you're listening, start early and just get money invested, whether it's at 10%, 5%, 15%, get your money in. Most people, though, they don't have a sense of that delayed gratification. They want everything now. They want to do the vacation now. They want to get that car now. They want to get that Starbucks freaking $7 latte with 2 pumps of pumpernickel, whatever they have in that flavoring, whatever. It's $7, $8 drink. That's costing them.
Yeah.
Okay, let's see how much it costs them, though, if they get 20% on their money. So let's say that you were a really good stock trader, or you went into a really aggressive mutual fund and you could average 20% a year. How does that change? Remember, 40 years at 10% got your $25,000 to $1.15 million. If you doubled the rate of return, now you go from $1.15 million to $37 million.
Oh, that's amazing.
And I did try to double check these. I'm sure everyone will. If I got it wrong, I punched in a number wrong, I'm sorry. Yeah. But the difference is going to be drastic regardless if I have it right or wrong here. 1.15 million at 10%, 20%, 37 million.
That's amazing.
Right? And here's the greatest thing. When we're talking about big interest or a big investment return numbers, if you waited that same 15 years, but you were still able to get 20% return on your money, okay, $2.4 million when you retire. So by waiting 15 years, if you have an ability to get 20% on your money, waiting that 15 years, the difference on that 25,000 is 2.4 million to 37 million.
Like 15 times.
15 times.
Yeah.
That's incredible.
That
it really is incredible. And just to think, we've done a show like this before, but the 10% for 40 years is 1.15 million. Think it one little over 1 million to 37 million just by doubling your rate of return.
Yeah. This is making me feel really bad because I'm almost 65 and I don't have anywhere near that much money.
Yeah, I don't either. And well, we're on our way.
I've been investing my whole life.
Okay.
What a failure.
The show was, though, what if I could show you a path to get to 40%?
Okay.
And I can already hear everybody talking, Joel, you can't do that.
Yeah.
People have been telling me I can't do stuff my entire investing
They're going
life.
to tell you, okay, maybe you could do that 1 year.
Maybe
you might get lucky and do it 1 year.
And I'm okay with that, right? I'm okay. But it is possible. Don't tell me it's not possible. And I'm about to show you how it's possible right now. Okay. So here's the example today. If you're listening, we're going to go out and buy $1 million building, commercial real estate building. It's a cash flow building. And the numbers are the same. If you want to know these numbers for a 5 million or 10 million, just take it times 5, take it times 10, doesn't matter. And this building is an 8.5 cap. And we're not going to review all that here, but that's the capitalization rate. And it means if we bought the deal all cash, it returns 8.5%. So if we paid $1 million for this building. We're going to get $85,000 in cash flow.
Okay.
Okay.
Per year.
So 8.5 cap, and I'm under contract to buy like 3 or 4 8.5 cap deals right now.
Yeah.
So don't tell me I can't find an 8.5 cap deal.
Yeah.
All right. So $1 million deal, I'm going to get an 80% loan. Now the numbers get even better if you get a higher LTV, which we have done. We get 85% routinely. Yeah. But if you just got an 80% loan, $200,000 is your down payment.
Right.
Okay. So that's what all of our investment matrix are going to be based on, is the $200,000 down payment. Once again, I know people are going to say, well, Joel, what about closing costs? I get it. Okay. You're going to have, $10,000 of closing costs, and you're going to need some operating capital. That'll change the numbers a little bit. But all I would have to do to counter that is to say, well, I found an 8.75 cap deal. Yeah, right. And now I took care of the closing costs. I got an 85%. Yeah. So, right. Okay. So the loan payment on a 25-year AM at 4.25%, which interest rates are going up, but we're still getting 4.25%. So the payment is $52,000.
Okay. $52,000 a year to service your debt.
Right. Now, remember, our cash flow is $85,000, and now we got a debt payment of $52,000. Okay. So the difference is our cash flow, and that's $33,000. Okay. So $33,000, we're going to put that over our down payment to get our return.
Right.
So we put $200,000 in, and I call it a money generating machine. We put $200,000 in, and it spits out $33,000 a year every year. Right. And that equals 16.5% return.
Okay, that's pretty good.
That's really good. Yeah. And for the naysayers, I like to counter their points, even though they're not here to have a discussion with me. Yes, cash flow is not guaranteed, and it kind of can go up and down. Yeah. But yeah, could it go down a year? Sure. But as rental rates go up,
yeah, it could go up.
It could go up. Yeah. And in fact, it will go up over time. Yeah. Over time, if you have a good property, rents will rise and cash flow will increase. Because remember, my loan is fixed for 25 years. Well, okay, it's only fixed for 5 or 10 years, depending. It's amortized for 25. So you to say that you're going to have a guaranteed loan payment for 25 years is a stretch.
We have a property that started at like 12% cash on cash, and it's up to 25%.
Right. And so for now, let's just say that rising rents offset a rise in interest rates in 5 or 10 years when we refi. Okay. All right. So next, the cash flow isn't the whole return on a commercial real estate deal. Right. We have a debt payment, and part of that is interest, but part of that is principal.
Yeah, so you're paying it down.
We're paying the loan down, which is increasing our equity, and whenever we sell, we get that money. Right. And so I did the math for us. Of the $52,000 loan payment, $18,360 of it is paying down the loan or increasing our equity. Okay. And it's not a return that we put in our pocket, but it is a return that we will get in the future. Right. And so let's do that math. I put $18,360 over the $200,000 that I invested. Mm-hmm. That return is 9.2% a year, just in equity buildup. So think about that, guys. If you had a commercial building, and you wouldn't want to do this, but if it was a break-even deal, no cash flow, the amount of money that you're theoretically making in paying down the loan is already equal to what most years give you in investing in the stock market, in the S&P, NASDAQ, or Dow.
Well, and that's just the first year.
That's the first year.
When the principal payment or the interest payment is the highest, right? And the
very good point. The first year is the lowest that you're going to pay down the loan. Every year that gets bigger. So the 9's going to go to 10, 11, 12. This return's going to get better, not worse.
So theoretically, you got your cash on cash increasing every year. You've got your equity increasing every year. So.
Yeah. So guys, we're already at 16.5% on cash.
In year one.
Year one. We are 9.2% on principal reduction.
Yep. Year one.
Now, what else is there?
Well, your property is going to increase in value.
Yes, the property is going to go up in value. We don't know how much, but we're going to pick a number. And I picked, for this example, I used 3%. Yeah. 3% on average nationally is pretty conservative. Mm-hmm. There's probably some markets that have some down years that are lower than 3. Yeah. But I would imagine the average is going to be way higher nationwide than 3%.
Yeah, probably is.
Right now, inflation's like 8, so it's 9%.
Definitely.
And inflation is rarely 0 or rarely lower than 0. And so, you may have a year that's 2 or 1, but you're also going to have some years that are 6, 7, 8.
Right.
We have a property that we purchased 4 years ago, and we're under contract to sell it at almost double.
Wow.
And so I don't know, I didn't do the math for the show, but we're probably 15, 20% year over year.
Right.
Now that's a unique case, but just 3%. So let's do that math. 3% over $1 million, which is the starting value, is $30,000. Mm-hmm. And yes, that isn't going in my pocket. Okay, but it is there. It's part of the return. And 5 years, 10 years from now, if you're averaging that, then you're definitely going to get that money, or at least some version of it. So I took that math, 30,000 over 200, and the return on just the appreciation is 15%.
Nice.
So let's add those up. You got 16.5% cash on cash. You've got over 9% in equity buildup or loan pay down, and we've got 15% in appreciation.
25. So it's about 40%.
40%.
Nice.
So for everybody that saw the title, make 40% on your money a year, and they don't believe it, I'm here to tell you we do it. We do it every day.
Every day.
And that's at a 4.25% interest rate. We have those. I just refinanced a deal at 3%.
Yeah.
Now that was right before interest rates started rising, but I mean, it's not like 4.25% doesn't exist. It's not like 8.5 cap deals don't exist. Yeah. And 40%, if I roll this out 5 years, the principal pay down's higher than 9%. The appreciation might very well be higher than 3% a year, and the cash flow is going to go up because of rising rates. So we could even do better than the 40%.
Yeah.
Okay, so let me do a thought experiment. And I know you can, very few people on the planet would ever be able to achieve 40% a year for 40 years.
Yeah.
Okay. So I'm not saying that someone's going to do that. I just want people to be able to open their minds to the power of how important it is to get the highest rate of return on your money possible. And if you invested $25,000 at 40% a year compounding for 40 years, take a second. If you're watching, think of the number. I guarantee you don't know it.
I don't even want to try to guess.
If the online retirement calculator and my Excel spreadsheet were correct, it's $17.5 billion.
$17.5 billion.
Billion.
Off of $25,000.
Off of a one-time $25,000 investment.
That's amazing.
And that's why
incredible.
Warren Buffett said it's the 8th wonder of the world. Guys, that's why we are trying to encourage you to invest in real estate. It is such a powerful tool. I don't know anywhere else that you can get 40% on your money. I don't know.
Consistently. I don't either.
And once again, I'm not taking like a pie in the sky example. This is an example. It's on a $1 million deal. It could be on a $10 million deal. Yeah. I could do this example for the $16.5 million deal that we did in Vegas.
Let's do that.
I'll have to redo the
trillions.
numbers.
Let's get into the trillions.
Yeah, but you can make 40% on your money, even if it's only for a 5-year window, and then you sell it and you have to wait another year till you find another 40% potential investment. Yeah. But this is why it's so important, is we've already demonstrated how waiting 15 years destroys your returns, right? Averaging a low percentage on your money destroys your returns. Right. And here's the thing that this whole show is about. It's about opening your mind to understanding what's possible. Because if all you've ever heard is that investing is risky, that high returns mean high risk, you're not going to look for a 40% return investment.
No, you're not.
You're not going to look for it. And so you're never going to find it. You're never going to invest in it.
You're going to forget about it as soon as you hear it's 40%. Someone claims
yeah,
it's 40%.
You're like, that's not real.
Yeah.
That's fake. Now, there's scammers out there that will tell you that they're going to do 40% all day. And we don't pitch 40% on our investment.
Yeah.
We're taking a percentage, we're syndicating, but we've consistently hit 20% for our investors after we take our share.
Yeah.
And we've been paying 20% compounding to our investors on multiple deals for years. And so for everybody listening, this it demonstrates the strength of commercial real estate. It demonstrates what's possible in the return metrics to get 40% versus 20% versus 10%. Most people, they just go to their job. They have an investment advisor come in. Yep. They say, you need to be diversified. Yep. You need to invest in all of these mutual funds for the long term. And they've averaged 8% a year. And that's the safest thing you can do. And everybody, what do? They start contributing to their 401k. They flip their little brain off.
Yep.
Well, he told me I just have to invest, and I've set aside this much money, and then I'll be able to have enough to retire. And they never think about it again.
Yeah.
And so what we're here to do is say you can make 40%. You can do it consistently. You may even do better than that on some deals. And a higher rate of return and starting early will absolutely change your life.
Yeah. Those are some amazing numbers.
Yeah. So I don't know. I don't think I have much else. I don't know if people have ever thought about that. But real estate is a great tool, and we've demonstrated it time and again that it can provide higher returns with lower risk than most other investments that average people have access to.
Yeah. Thanks. All right. That was great, Joel.
All right, guys. Till next time,
right.
How to invest in commercial real estate. Hit the like button. Send us an email if you have a topic, and subscribe to our newsletter. That'd be great.
Yep. Thanks, everybody.